The psychological risks of defining yourself as an investor. At first glance, identifying as an investor sounds positive. It suggests responsibility, discipline, and financial awareness. But from a behavioral finance and psychology perspective, strongly tying your identity to being an investor carries hidden risks. Here is a research-based breakdown. 1. Identity fusion increases emotional volatility. When investing becomes part of your identity, portfolio performance stops being just financial. It becomes personal. Behavioral research shows that when outcomes are identity-linked, gains feel like validation. Losses feel like personal failure. Volatility becomes self-worth volatility. This connects with findings by Daniel Kahneman and Amos Tversky on loss aversion. Losses hurt roughly twice as much as equivalent gains feel good. If your identity is tied to your portfolio, drawdowns don't just reduce wealth, they threaten self-esteem. That increases the probability of emotional decisions. 2. Ego involvement reduces objectivity. When you define yourself as an investor, you may unconsciously shift from "What does the evidence say?" to "What does this say about me?" This introduces ego-protective behavior, holding losing positions to avoid admitting error, doubling down to prove you were right, rejecting contradictory data. Psychologist Leon Festinger described this dynamic in his theory of cognitive dissonance. When evidence conflicts with identity, people distort information rather than update beliefs. Strong investor identity can reduce intellectual flexibility. 3. Overconfidence bias becomes reinforced. Research by Barber and Odeen shows that investors who trade more frequently tend to earn lower returns. One major driver, overconfidence. When you self-identify as an investor, you may feel expected to have opinions. You may feel pressure to forecast. You may believe you have superior insight. Identity can amplify illusion of control, a concept strongly associated with behavioral finance research. Ironically, the stronger the identity, the more difficult it becomes to admit uncertainty. 4. Action bias increases. Humans prefer action over inaction under uncertainty. This is called action bias. If you identify as an investor, inactivity can feel inconsistent with who you are. But long-term wealth creation often requires strategic inaction. As argued by Burton Malkiel in A Random Walk Down Wall Street, excessive trading rarely outperforms broad market exposure. Identity can push behavior. Investors act. Investors rebalance. Investors optimize. Sometimes the optimal move is restraint. 5. Emotional amplification during market cycles. In bull markets, identity feels validated. Risk-taking increases. Confidence expands. In bear markets, identity feels threatened. Anxiety increases. Defensive or panic decisions rise. When market cycles affect self-concept, emotional amplitude widens. That emotional amplification increases behavioral errors. 6. Social comparison intensifies. If you see yourself as an investor, you may compare returns, stock picks, timing ability. Social comparison theory suggests individuals evaluate themselves relative to others. Financial media and online platforms intensify this effect. Instead of focusing on long-term goals, identity shifts toward performance competition. That often leads to chasing trends, switching strategies, taking excess risk. 7. Narrow identity reduces diversification of self-worth. Healthy psychology requires diversified identity. Professional, family role, personal interests, physical health, social relationships. If investor becomes a dominant identity, emotional resilience decreases. Market volatility then affects broader life satisfaction. A diversified self-concept acts like psychological risk management. 8. Performance becomes a reputation issue. Once you publicly identify as an investor, friends ask about markets. People expect opinions. There is reputational pressure to appear competent. Reputation pressure increases risk-taking. It can push individuals toward bold predictions, concentrated bets, defensive justification of mistakes. Humility becomes harder. 9. Confirmation bias strengthens. Identity-driven investing increases confirmation bias, the tendency to seek information that confirms existing beliefs. Research in behavioral decision theory consistently shows that identity-aligned beliefs are harder to update. Instead of evaluating evidence objectively, the mind protects the self-image of being knowledgeable or skilled. That slows adaptation. 10. Financial outcomes become psychological outcomes. When identity and investing merge, net worth affects mood. Market news affects confidence. Portfolio swings affect self-perception. Wealth volatility becomes emotional volatility. This increases stress and reduces long-term discipline. A healthier alternative, identity as a process follower. Instead of identifying as, I am an investor, a more psychologically stable framing may be, I follow a long-term financial process. This shifts focus from performance process, ego discipline, prediction probability, identity system. Research consistently shows that process-oriented thinking improves decision quality under uncertainty. Conclusion. Defining yourself as an investor carries hidden risks. Ego involvement, overconfidence, action bias, emotional amplification, social comparison pressure, confirmation bias, identity fragility. Investing works best when it is a strategy, not a personality. The strongest investors often treat markets as tools, not mirrors of their self-worth.